Hello, I'm Jonathan Frutkin, and I realized when I was introducing other people that I kind of forgot to introduce myself. Um, I'm an attorney in Arizona at Radix Law, but the reason why I'm involved in all this is because I wrote the book called Equity Crowdfunding. See, I've always considered myself kind of a futurist, like what's going to happen next. And in that book, I predicted that crowdfunding would basically combine this incredible world of social media into this explosion in the ability for smaller companies to raise capital. Of course, that didn't happen. So I went on to predict that Donald Trump could never become president, and that, of course, was a wrong prediction as well. So, like anything I say, take all this with a little bit of grain of salt, okay? You know, one thing that I've definitely noticed from kind of the olden days of the 1990s is that we have this varying level of technical knowledge and technical language when talking about blockchain and talking about securities and stuff like that. And so most of the time we like nod at each other and we're like, right, but we don't know what each other are talking about. So because I'm terrible being a futurist, it's like a comedian who can't tell a joke tells a pun. I'm going to use an analogy. So this is what's happening in the marketplace, at least from my view. Imagine a world in which somebody has decided that they need to make self-driving semi-trucks, okay? And this person, kind of layering on the world of self-driving cars, decides that there's a great opportunity in the world of truck driving. Obviously, it's dangerous, it's extraordinarily expensive, and it's an area that's absolutely ripe for innovation. And so this person says, hey, I need to go out and raise some capital. And they talk to me or Sara or somebody, and they're just down in the dumps about the whole thing because it's so complicated and there's all these rules they got to follow. And they say, well, what's another way to raise money? And they come up with this idea. So instead of raising money for going ahead and having this special semi-truck that drives itself, they decide instead of selling interest in that company, they're going to go ahead and create special gasoline that only that semi-truck will run on. So this special gasoline is what they create, and they go out and they sell the gasoline. With the money, that person's then able to develop the semi-trucks, and that semi-truck will only run on this special gas. And from the perspective of somebody who wants to make money, they're sitting there holding the special gas that's going to make the trucks run. That is so dumb. I mean, it's really, really dumb, and that is exactly what's happening right now. You have entrepreneurs who are demanding capital, and at the same time, they feel, for various reasons, like they can't do it within the rules that exist today. At the same time, the people who buy the gasoline love the fact they're able to trade and sell the gasoline even before this semi-truck is made. And so what's really happening here? We're seeing a combination of the demand for capital from entrepreneurs. At the same time, there's demand for liquidity, easy access to high-growth securities from investors. And so while all this is happening and we're living in this kind of stupid, strange world, all of us, meaning lawyers and people who are market participants, are trying to figure out the best way to address that. So let me just back out of the analogy world and talk about why we have securities laws in the first place, because I swear there's probably 60% of people in the room who think that it's just stupid. It isn't. Here's the reason we have securities laws. We demand that companies be transparent and that they tell the truth. And that's really it. And then we have a whole bunch of rules that explains how we're going to do that, but that's it. We just want companies to tell us what's going on and be honest with us. That's securities law. And so amongst all this, we've built up a various bunch of exemptions and regulations and other things that are very, very scary to a company and very, very upsetting to investors because they aren't able to just put money in whatever they want. But at the same time, sometimes we forget the whole point in the first place. So what's driving blockchain in the first place? Well, there's a few things. I mean, first of all, and the most important thing is something that Vince kind of touched on, which is wildly more efficient. The ability to transact transactions through the old broker-dealer system and clearing is really, really expensive and slow. The analogy that I have is credit cards. there's no reason why this is so terribly expensive to run a credit card. If you're in a business where you accept credit cards, you know that you're spending thousands and tens of thousands of dollars a month, depending on your business, on credit card transaction fees. Something the blockchain could do efficiently, perfectly, and a lot cheaper. And so there's an efficiency mechanism to it. But there's also something about the liquidity. There is a incredible demand from investors to have at least the ability for liquidity. That's the reason, obviously, there's a jump once something is tradable on an exchange, and that's why there's a reluctance from investors to invest in things with a long time horizon. And let's not kid ourselves. I mean, there is a demand out there for higher returns. There are people who are looking for at least part of their portfolio to be in high growth stuff. Would those people love to invest in the semi-truck company? Yes. And there's an element of that that is behind all of this explosion in ICOs. I don't think that there's any lawyer that you're going to talk to or any policymaker that you're going to talk to who thinks that the status quo of this year is going to remain the same. For a lot of people who've been in capital markets for a while, at least since the tech boom of the 90s, there's kind of an understanding that we get these little puffs of energy. But while we expect that most of this stuff is going to come within the realm of securities law and regulation and things like that, we also can't forget what is really driving all this behind. So to follow Sara, I'm going to go ahead and publish something today. One area that is kind of comes up again and again is the ability for people to quickly go on exchanges and to trade their tokens. And one of the main reasons why people obviously invest in the first place is the fact that liquidity is available quickly. One of the comments, kind of the footnote in the Dow Investigative Report from the SEC indicated that, of course, for securities, they need to be traded legally. And so I'll be publishing a summary white paper today on what a national registered exchange would look like on the blockchain. Now, there's some challenges to be sure, but there's also no question that the efficiency that comes from the blockchain, the ability to have liquidity, and the ability to have potential for higher returns will be best served by something that fits within the existing law. So with that being said, I'm going to, first of all, remind everybody if they have questions to kind of come up here, and I'm going to turn it back to Sara. And I'm going to sit down while she answers this question. But the question for Sara is, of course, you haven't included some things, and so that indicates to me that you've been thinking about some things. So talk to me about version 2 of your report, and what are some of the other things that are going through your mind that you just see and you're like, yeah, that's something people need to think about and they haven't.
One of the things that I think we need to spend a little bit more time on is one of the issues that I raise, which in the memo, which is some of this works pretty well with LLCs and kind of doesn't with corporations, because corporations are set up according to very strict rules about how both what goes into the nature of a security under the state law and how you track that. And so the next version is definitely going to have an expansion of the discussion of, okay, so Delaware said you can do this on, and I've been told don't say on the blockchain, say using blockchain technology. So you can do these trades using blockchain technology. Delaware law says that. But unfortunately, Delaware law also says you've got to have a list of security holders, which means that there's no anonymity there. So looking further into not just Delaware law, but the other state laws, and seeing how easy is it to make these two things work. Because going back to what Vince said earlier, I mean, anonymity kind of doesn't work, at least with respect to the initial distribution. Initial distribution, if you've got a broker there, broker's going to say, there's nothing we can do about it. We have to know who we are giving money to, where the money is going. We have to know who these people are. But maybe anonymity works more in the subsequent trading. if we could find a way around the corporation law. But I'd be interested to know whether Vince thinks that the no anonymity thing, is it an initial distribution or is it secondary trading? Are we always going to have known people behind those addresses?
Let me kind of frame that a little bit differently, and again turn to Vince. But my question has always been, do people actually care that much about anonymity? Like, once the rubber hits the road, obviously there are a lot of people who were initially attracted for various reasons to Bitcoin and other cryptos because of the anonymous nature of it. But we've got a lot of people who are sharing what they're eating on social media. Like, to me, it feels like the idea that, hey, we're going to know, at least have the ability for people to know who the owners of record are of a company. Does it actually even really matter? So, Vince, we've got two questions. One is maybe a technical question about whether we need that information, and the other is maybe a philosophical question. Does it matter at all?
So I think it's first a holistic statement of how we've approached the market, and to a lot of degree, Jonathan and Sara as well. This goes back to early days of pre-Jobs Act, Jobs Act, as we looked at the wonderful world of user interface, crowdfunding, general solicitation, and how do you utilize social media responsibly to distribute securities. So our larger view was really born out of the fact that it felt a little bit like deja vu again when we were looking at blockchain 2 and 3 years ago, and we started to hear people say, oh my goodness, we're going to disrupt financial services, we're going to change the world. And they'd never even heard of the 33 or 34 Act. So that's scary, right? So we looked at that and said, our belief system tells us in the world of securities, we truly don't believe there's such a thing as a fully decentralized ledger, right? The moment that you're dealing with a security, you have an introduction of an SRO, a broker-dealer, licensed people, an ATS, exchanges. Therefore, you are semi-centralized at best. So you kind of got to throw out the full ICO blockchain script for a second and say, what do we need in that process? We need permissioned nodes, we need regulated nodes, which are able to interact and move that transaction through the system. So that, again, to our specific business plan, and we did write significant patents that are pending in this regard, and not that we're looking to dominate the space by having patents and being against the ethos of ICOs and open source, but the reality is if you're going to play in the securities world, we need a level of standardization and best practice and investor protection, and that's what was really born those patents. Next to that, we've done another series of patents that are pending around the smart contract that are called RegCoin. And this is really the ability to bake into a security framework into that smart contract that has profit participation. It has yield. It could be a debt instrument. It could be an equity. It could have voting rights. It could have this full dynamic. And within that dynamic, you have resale provisions. You have 12G, as Sara talked about. You have clocks on that token that have a countdown to the resale ability. So that's a long answer to say we're thinking about the market holistically in a manner that says anonymity is a no-no, particularly at the origination standpoint. You cannot possibly conduct AML or do any kind of suitability requirement without knowing who your customer is. Therefore, it's a non-starter at the origination standpoint. Can you be trading in an anonymous fashion at a broker-dealer, so that broker-dealer is the one disclosed who is transacting on behalf of their client? We think that is a yes. So that's a semi-disclosure to protect that investor's true identity, but they have to be transacting through a regulated entity. We think there's a huge movement, particularly around when we move impact investing and blockchain together, when you have the ability to have stakeholders who are investing more in corporations that they are aligned with, and those stakeholders are now becoming consumers, and consumers are stakeholders. You could think about disintermediation of a large portion of street name here, right? Because there is no street name equivalent for private securities. So all those shareholders or stakeholders are disclosed directly to the issuer. so they can communicate with their stakeholders directly, unlike street name today where you have to go through whether a proxy company or whomever it may be in the process. So I'm not sure if that's a direct answer. So we think anonymity on the front end, absolutely not. Some process of that stakeholder transacting through a regulated entity may provide some level of privacy disclosure if that investor does not want to be fully disclosed to proverbially the network or the street.
So, Sarah, from your perspective, I guess a two-layer question. One is, am I right about the purpose of securities law? Is it transparency and just tell the stupid truth? Or am I missing something? And I guess as a follow-up question, we've seen the kind of beginnings of, hey guys, you really can't be doing this out of the SEC. Kind of walk through what you believe the continuum is, like obviously about what the enforcement thus far against flat fraud, right? We've had that, and we've had a little bit of guidance about celebrities and whether or not something's a security or a utility token. Talk us through those couple things.
Yeah, so I would phrase the whole securities law thing slightly differently. And I'd say that the whole purpose of securities law is to permit people to make an informed investment decision. And I think that sort of that is what underlies a lot of the changes we've seen with crowdfunding and the Jobs Act. So long as you know what you're getting into, you should, nobody, especially the government, should tell you what you can and can't invest in. They should set out the rules whereby you understand that something is incredibly risky, and if you understand it's incredibly risky, then go ahead. Because God knows, I would never have invested in Facebook. It's the stupidest thing I ever saw. I still think it's the stupidest thing I ever saw.
I actually thought Starbucks was stupid. So what do I know?
Yeah, Facebook, as far as I can tell, it's for my sisters-in-law to have feuds with each other. I just don't get it at some basic level. But I would be the wrong person to make that decision. The people who make that decision would be my sisters-in-law, who would have invested in it if they'd had the correct information. So that's, I think, what we should all be striving for, informed investment decisions. With respect to the continuum, I think we've seen this with the Commission in all of the Jobs Act area. We have seen folks pick up at the Commission, pick up the phone and call companies who are doing something wrong and say, you might not want to do that, and you might want to have a word with your securities lawyers. And what we've seen in a number of areas is guidance through, hey, that's a bad idea. Guidance through warning as opposed to regulation through prosecution. And I think that's a good way of doing it, especially when you're talking about early stage issuers who really might be doing things completely innocently, and they might not have told their lawyers, and I speak from experience, what they were doing. You get a little bit stricter when the person doing the wrong thing is someone who is regulated. I think the Commission is a little stricter on that. But there is this continuum of regulation by friendly phone calls, by less friendly phone calls, by what the hell are you doing, we're going to sue you. But I think at some point, the market discipline is going to be imposed not by the Commission, who have limited resources for bringing up things. They have to pick on a policy basis who are they going to make examples of. The people who are going to drive this market are the plaintiffs' lawyers, and I think people should be very scared about plaintiffs' lawyers.
Yeah, I guess from my perspective, because so much of this is happening overseas and other things, that capturing that money will be a little bit more difficult than maybe in some stuff that we'd seen previously. But the numbers are really staggering. In the second quarter, venture capitalists put $235 million into companies, and there was $729 million raised in ICO sales. The amount of market cap at this moment of Bitcoin's over $200 billion. I mean, the numbers are just absolutely staggering, which is kind of like pointing out that there's a demand for something here. So just, I guess, on another self-validation point, Vince, do you agree with my premise that the demand here is being driven by something the market hasn't been able to provide previously?
I'd say this is very early innings, and this is a case study of a demonstration by virtue of market participants and perhaps irrationally investing in things very quickly without understanding that they're investing in. But we're onto something here, right? And this is one of the reasons why we're trying to move the market to a compromise and collaboration about engaging with regulation so this entire marketplace doesn't get screwed up, right? And we can holistically continue to use this. And just one little quick point, because I think Sara really nailed it when you talk about continuity of information. It's one of the things that we think are massively important in using smart contracts and the blockchain, particularly in secondary liquidity. There is continuity of information to all investors, right? As we have private securities conducting today, who gets what information, when they get it, who's privy to what potential sale and being marked up, it's all there, right? If we could think that you have an order book, bids, offers, displays, hashtagging back to the company's offering, last pricing, all within a smart contract, that is amazing ability to level the playing field and dissemination of information across all investors, where, regardless of where they may sit globally or within the wealth stack. So we think that's another major component of what's happening today.
We have time for 2 questions.
Yeah, I was just going to ask. So, how do we ask questions around here?
Go ahead. I think the gentleman had the Gary, you had a question? I have to go up there? No, it's okay, Gary, go ahead.
Just a quick question for Sara. Sara, I agree with you that Regulation 8 Plus is the best of our kind of limited options for these offerings. I've been telling clients that myself. What are your thoughts on the resale restrictions? Once the tokens have been issued under Regulation 8 Plus, they're unrestricted, but they're still not entirely fungible. So what are your thoughts on that at federal and state?
Well, I mean, yeah, the important thing is at the federal level, they are non-restricted. They can be traded freely. There is a presumption that 4A1 is available for their trade. The problem that you run into at the state level is there's no preemption for secondary trading, which I think is one of the 2 fundamental issues with Reg A, the other being 12G. And I think it doesn't matter so much for the it might actually be easier to do the trades using block trade technology, provided that you've kind of built into the smart contract some way to check which states there are. I mean, you can write algorithms that say this state to unsolicited unsolicited buyer, unsolicited seller, fine. This state you need the broker dealer to be involved. This state you don't, and so you can take the patchwork of secondary trading requirements and write them into an algorithm, which I'm assuming Vince is sort of thinking through that right now if he hasn't already patented it. But that would be a way to do it rather than have anybody having to think about it. Just build it into the contract. But you do have to go state by state. And some people are going to sort of push the button and go, oh, I can't sell. Why can't I sell to him? Well, so.
Next question?
Yeah.
Go ahead, sir. Could you introduce yourself?
Sure. My name is Jim Angel from Georgetown University. Sara, you mentioned the specter of 12G, which puts a limit on the number of shareholders of record.
Mm-hmm.
Now, that doesn't include beneficial shareholders. And as you know, for most public companies in the United States, most of their shares are not held of record, but beneficial ownership. And indeed, there are many NYSE-listed firms that only have a handful of shareholders of record because the nominee CD and company is their shareholder of record. So what are your thoughts about creating a nominee to be the shareholder of record that would sort of insulate the rest of the beneficial shareholders from 12G exposure?
Sure. I mean, we've got a couple of solutions to that being used at the moment in the Reg A market. There is a number of platforms and intermediaries who are using custodians as the holder of record. So you can put that in, you could push that into the blockchain technology. And the other thing is that that I suggest in the memo is right now I think the best option is to treat each address as a holder of record. and then build into the smart contract some limitation that says if you're Reg D, boom, you stop at this point. If you're Reg A, you stop here. But we don't have an answer to that. I mean, that there is, who is the holder of record? The other option, which was suggested by one of our clients, is to sort of do the custodian issue, where issuer issues mega token to, in fact, to the transfer agent. So it gives you the ability to put a transfer agent where you don't actually need one, but you've got it now, so you've got the conditional exemption. Transfer agent is one holder of record. Transfer agent then securitizes or tokenizes the tokens, and then they trade as they please. Does it work? I don't know. We might ask the SEC about that at some point, but yeah, evolving area. But we just have to be very, very careful about 12G. I think, and to re-answer the earlier question, I would love to see a policy decision being made that companies should not register with the SEC until they are ready to register with the SEC, especially if they're already reporting under Reg A. You've got the disclosure there. You've got the periodic information being transmitted. Why does 12G not? Why is it a conditional exemption?
And as a futurist, I would suggest that both 12G, which is basically, was addressed to a limited degree with the Jobs Act from raising that number from 500 to 2,000 holders, is very antiquated. Going to Sarah's point about where we've evolved on Reg A, it becomes very antiquated in that, and the accredited investor definition and existence and et cetera are issues that we can, I would feel comfortable, along with my Trump prediction and crowdfunding prediction, to say will be changing very shortly. With that said,
I have a question.
please, Sidney.
Can I ask you, we had equity crowdfunding since 2012 and implemented sooner. We had any of these ICOs?
So, yeah, let me frame. I think the question that Sydney's asking is, in your opinion, if the crowdfunding rules were done the way that there was at least some intent by some people in 2012, if those rules had gone through in a way that was a little bit more open and welcoming, would that have basically obliterated what we now see in the ICO market, or is this just a totally separate phenomenon?
I think they're separate phenomena. I really do. I mean, I don't have problems with the crowdfunding regs. They are pretty easy to comply with, especially Reg CF. I mean, you look at some of the platforms, there's no legal fees involved at all with respect to the disclosure. It's all taken care of by the platforms. And the problems that I see in the Reg CF offerings, it's always with corporate law, never with securities law. So I think once everybody got over the, oh my God, there is like 6,000 pages of disclosure stuff, and then realized, oh, we can write software that says if you have X, then you do this. If you're an emerging company, then one sentence here. I mean, the platforms have got some very nice systems right now. So. No, I don't think it would have changed it.
I think, yeah, I would just add on that that I don't think that's what's driving the lack of crowdfunding. I think it's something that Vince has been trumpeting for years, which is the secondary market and liquidity. The fact that that is so easily and instantly available in the ICO market drives a lot of market participation in a way that Reg CF, maybe we overlooked it, but Vince didn't. But maybe we didn't spend enough time on it. But that's driving a lot of it, from my view. Any final words, Vince?
Look, I think we're way better educated as market participants, regulators, and legislators today than we were 5 or 6 years ago when we were talking about CF or any of these others. So I think as the timeline continues down the path, we've been in some level of experimentation. First reactions from regulators to general solicitation a number of years ago. Oh my goodness, are you crazy? Well, now there's a comfort and acceptance. So I think what we're thinking today is going to be dramatically different in 5 years from now as well. And we probably have a holistic revisiting of what our capital markets look like as we continue to have innovative technologies intersecting with the world of capital.
Thank you very much.
Thank you.
Thank you.
said.